Weiss, president of Napier Financial, and I'm here to talk about a business owner I recently met. And they seem to have everything that they needed except a plan. They own roughly 60% of their business. The other 40% was owned by a multitude of other family members. No estate plan, divorced, but a little while ago. Parents with good size estate plan, but irrevocable trust and a little confusion there, but definitely significant assets. And the gentleman wanted to actually sell his business. And it sounds fairly overwhelming. And the question I got is, where do we start? It's really hard to figure out exactly where to start because everybody is different. So before this person and family got overwhelmed, we took a step back and really laid out the goals and figured out, why are they here in front of us today, and why is it important that they want to sell their business today? Are they getting outside pressures from family members? Are they getting outside financial pressure that they feel like they need to do something? Whether it's, you know, living up in the Northeast, people always want to go down to Florida. Do they feel like they just were missing out? Did they have some health issues that they weren't fully disclosing? And they know that their time is extremely limited. So you really got to figure out and dive into, what are those perceived or not, pressures or obligations that are really the impetus for the sale of the business at that time. Because if we've been working with someone for a long time, usually people plan these things out well in advance. But in this case, when we met that person, it was, why are we actually here today, and why aren't any of the people working with you able to help support that process? Now, we don't want to overwhelm someone. However, you have to have a few trains leave the station at a few times. First is, you need to get your facts straight. You really need to understand, at the core, money in and money out. What are they spending? What do they have? Where is it coming from? Are they Social Security age or not? Are they have any other outside sources of income or not? Where do they actually stand? Because it backs into what they need to get out of the business. And I should say, most people believe that they should sell a business for the most amount of money they can. Well, that's not always the case. There could be another family member involved that wants to buy them out. There could be an outside buyer that isn't top dollar, but might be the best fit long term for the business or the employees. So you really need to focus in on, what do they need to get net, net, net after tax, because structure of the sale of the business will matter too. Just because it has a higher dollar amount doesn't mean it's going to be the best net to your pocket at the end of the day. Really important to understand. The other part of that scenario that you have to set is the estate plan. And because we all drive on the same roads, we see people get sick, unfortunately, all the time. We need to get at least a simple but a revocable trust-based plan into effect. Where most people get caught up in those plans are on the distribution of assets after they pass. And in some of these cases, we want to set up the plan, not spend a ton of time because we still don't want to get stuck at start, knowing we're going to spend much more time on the distribution of assets post the sale of the business, when the money becomes real. Even though it's real money, it just becomes countable in their bank account. So they think it feels like it's a little bit more real. The other part then is, then we want to back right down towards financial forecasting. Okay, now let's forecast we sell this business. Now, what do you need to earn on the money, investment wise? Where's your income going to come from? What tax classification of income do we want based on your other outside factors, what you've already saved, what you've done outside of this? How is this going to be treated? Capital gain, ordinary income, combination of both? Working with the attorney and the accountant to make sure that those assumptions are made correctly based on what we know about the business. And then start backwards building the plan and forecasting, so that person is actually comfortable with the sale of the business. So they know if they sell their business for X amount of dollars, that they are going to be able to replace that income that they've had for however many years that they've been doing it, and knowing and specifically, because life changes, but generally where it's going to come from and why, knowing where they have the flexibility to pull their levers. Then you want to start backing into the rest. How are you going to invest to support that? What other protections do you need? Do you still need that life insurance policy that you had from 25 years ago post sale of the business? Maybe, maybe not. Maybe you still need it, but maybe it changes from income replacement on the business to a legacy asset for you. Or maybe it's just time to cancel it altogether. We don't know. Make sure that disability insurance policy is canceled when that time is right, if you still have one. Because by the time you sell your business, let's hope you don't need it, and let's hope you're retired and don't have to collect it. And once you start implementing that, it's real important that we see people follow up and follow through on some of these tasks. Now let's fast forward. You're going through the sale process. You have to make sure that the right person to sell the business, whether it's a broker or an investment banker, depending on the size of the business. You want to make sure that the tax team is ready at the same time. You want to make sure then they have an attorney that can actually speak their language. And when doing all these things, you want to make sure that all of those are the three main people in that process outside of a team like ours. You want to make sure that this is not the first type of business they've sold like this, because they're all going to have their little nuances on how asset heavy they are, how much it's purely an EBITDA play versus an EBITDA and asset play, how much the real estate plays in. Did you pay enough? Did you pay enough in rent? Do they have to normalize the rent? Were you underpaying or overpaying yourself? That has to normalize in your profit and loss. And I can go on and on and on. This goes back to that trying not to be overwhelmed. But if you get the right people that have done this before in the space that business is in, you are going to have typically a far better outcome because they're going to be speaking the same language, and also picking the right kind of personality. You can have a great attorney, but if the attorney is, you know, really high tech focus, all they want to do is Zoom and Teams meetings and sending over super long detailed emails, but you're working with someone that's a little bit more old school that wants to meet in person and wants to kind of slow things down. You got to meet people where they are. So you really have to make sure that not only are the expert in the space, but they're going to actually meet the client where they are. In this case, you got to be just very mindful of that. Then post sale, let's let's make sure that you reconcile from your forecasted plan to what actually happened. Now that may sound silly because the chips are going to fall where they lie, right? You're not going to sell the business for more or for less. It's sold for what it's sold for. But if you can then show them, okay, we forecasted this, you have that. Here's the delta. Here's how they're going to make up the difference, or what do you know? You have slight excess. Then we can start working on that wish list where people can start to think more clearly. And then you finally go back to that estate plan and kind of put a bow on that and any other loose ends that may have been delayed or deferred because there either wasn't time, it wasn't the right time for a final recommendation, or they were just paralyzed by too many decisions that now hopefully they have a little bit more free time. So those business owners that have it all sometimes don't have it all because they don't have a plan and they're just looking for that ability to put a nice little wrapper and bow on it to get something delivered that they couldn't deliver themselves. One of the red flags that we see in the business sale process is clean books and records. A lot of people get tripped up in the sale of a business through the normalization of earnings and what their actual profit is. You own the property where you're renting your business from. That should be market rent. If you are underpaying yourself rent, they're going to normalize that, and then all of a sudden your profit's going to go down because should be paying yourself more. That'll get normalized. Same thing on the income that you pay yourself. If you're a president of a company and that should get paid X, but you're paying yourself half of X, they're going to normalize that, which is going to actually bring down your profit because someone buying your business is going to replace it for fair market value. So the normalization of your profit really needs to be looked at in advance. Not only that, in a perfect world, it's usually 3, sometimes even longer, 5 years to start to dress up or fix up and build your earnings in such a way that is trackable, is profitable, and that all the categories actually jive with one another. Understanding how profits and loss statements work and making sure that someone else looking at them asks as few questions as possible gives less up into interpretation and less digging into all the numbers that you have in your business, which therefore should maximize the value of your business long term. Another red flag is the inability to implement a financial and investment plan post sale. What can happen, or most people will sit there, they'll have a sum of money in their bank account, and then they'll freeze. And just like compounded interest, Albert Einstein and I love compounded interest. I was a math major for all. You still need that to work for you, even if you sell your business later in your life, because we're not always just investing just for use. We're putting money in irrevocable trust sometimes, we're gifting, we're making plans outside of just your life that we want to make sure that investment plan is implemented so time can work on our side. You don't want to sit there in cash. Well, cash will not lose value on the way down. It will lose ground to inflation on a year to year basis. And while short term that may feel good, long term that'll typically hurt. Not having a plan is just having a bad plan. The earlier you start planning for an exit of your business should equate to a smoother transaction for you, your family, and the key people within your business.